talk a little bit about ratios and whatnot, but first I want to go back just briefly back to that those capital or equity accounts. And I was looking at Apple, and I didn't do a great job of explaining everything there, but um, part of that was when you look at this, the total capital stock, okay, and that's going up even though they're buying back stock. It gets to be a little bit confusing, and some of these equity accounts can kind of be that way. A lot of this, I'm going to tell you that when you're doing your financial analysis, isn't that important. Okay, I don't want to minimize it necessarily, and I want you to kind of look at it and understand it, but it could also be kind of confusing. And so I wanted to go and look just at Apple's 10K so I could kind of show you maybe how this works a little bit. This is their 10K, and you get down to the consolidated statements of shareholder equity. Okay, great. So here's their beginning balances, and they're decreasing. Okay, again, that is very consistent then with the fact that they're buying back stock, as we'll see. But if you remember that let's just go look at that. The total paid in capital, and you see those accounts and how they go from 45 to 50 to 57. Here's what's happening there. Here's those numbers. Okay, so they got beginning balances. This is just shares that they're authorized to issue at a par value. Okay, doesn't have a lot of meaning in terms of our financial analysis, but it's kind of important to understand when you're looking at it why it is or isn't important. So here's the beginning balances, and they keep creeping up. Well, why is that? Well, they issue some stock. Why would they? They're buying back a lot of stock. Why would they issue some stock? Yeah, special reasons. There's some down here that we'll look at, and they got share-based compensation. So they give shares to some of their senior executives in lieu of regular compensation, and so that's part of it. This is, probably something a little bit different, maybe some other deals that they work out. You can see these amounts aren't that huge, for product or services or something like that. And common stock withheld related to net share settlement of equity awards. What that is, I'm not 100% sure. Not a huge factor, but that gives you that total paid in capital, which is, or common stock and additional paid in capital, which again isn't terribly relevant. It's the shares, the value of the shares outstanding based on the par value. Okay, this is where it gets more important. So retained earnings, boy, look at that. Beginning balance is just decreasing, even though they're making 55 billion that year, 57 billion that year, 94, nearly 95 billion dollars in 2021. Okay, common stock withheld, again, kind of similar thing there. Okay, that I'm not sure what those mean. It just has to do with compensation again of executives and whatnot. But common stock repurchased, so they're actually buying back in these 2 years. They bought back more stock than what they made. Here's their net income, and they bought back more stock. Which leads to the cash that they had on hand. This year, 2021, they made about 95 billion, and they only bought back 85 billion dollars in common stock. Okay, and so there's there's your retained earnings balance anyhow there, and again, you come up and you get the total shareholders' equity, which is decreasing, which again is just a result of their huge share buybacks. Okay, why? I think Starbucks we looked at, and they had a negative equity position, and looks like Apple's well on their way. None of which has anything to do with its ability to make money going forward. It doesn't diminish that ability at all. So it doesn't diminish the worth of the company on a per share basis. Then the company should be worth more as there's fewer shares outstanding. Okay, enough on that. Let's move on then to some of these ratios. Okay, and the first company I looked at, because it is one that you guys have picked, is Walmart. Now, and this is stuff I had you guys calculate, but I found it here under the FINRA. And if you go to the financials, but if you just scroll down a little bit, then you see the key statistics. Okay, and I found the operating and that's all I'm going to talk about today, is the operating and efficiency statistics. I found these to be kind of key, and this kind of delivers some of the information that I used to find really interesting in their old format. But when you look at a company like Walmart, okay, it's kind of a department store and also a grocery store. I can tell you grocery stores have amazingly thin gross margins. Okay, so Walmart's got part of that, and then the other side of Walmart is that they're kind of general merchandise, and probably has a little bit better margins, but still not huge. And so, we'd expect its overall gross margin. Remember, gross margin is revenue, okay, minus cost of goods sold, and theirs is 25%. Like that, steady. Okay, I'm going to show you. I'm just going to click really quickly over to. This one's Nike. Now, what would you think Nike's gross margins are? They're selling kind of a specialty. They are selling specialty products. Specialty shoes are kind of upscale. Their clothing's kind of considered a little bit. I mean, it's not fancy tuxes or anything, but I mean, it's considered top of the line stuff, right? And so it's got a gross margin closer to 45%. One of the reasons I say you can't compare, Walmart to Nike, what you got to do when you take a look at these is see how their gross margin is done over time, okay? And much like Walmart, not a lot of change there, okay? You're looking for some significant change there. It's worth commenting that, Nike's been able to maintain a gross margin of around 45% for the last 10 years. Walmart's been able to maintain a gross margin of about 25% over the last 10 years, okay? Then one other company I took a look at, and that was Microsoft, because what's Microsoft sell, right? What's their cost of goods sold, Gosh, they sell a few programs and whatnot, lots of programs and whatnot, but does it really cost them? Well, they can probably attribute some of those costs to the cost of goods sold, but not a ton. So you would expect that they would have a very high gross margin, and they do. Started out 69%, and guess what? 10 years later, or not quite 10 years later, 7-8 years later, it's still at 69%. So all three of these companies have done an excellent job of maintaining their gross margins. Now, let's take a look at the next line down, operating margin. So what's that? So you've got your revenue minus your cost of goods sold, and then you got your operating expenses. It's paying for your administration, your rent on your buildings, those types of things, right? And then you end up with an operating margin. And once again, you would think for Walmart that would be thin. They got all kinds of buildings to maintain, heat and payroll. They're one of the biggest employers in the United States. So they've got a thin margin. Look at that. Their operating margin was 6% there, still at 5%. So they've done a reasonably good job of maintaining it. But 1% is a big deal on, their sales are over $1 billion a day, right? So 1% is still kind of a big deal. And then net margin, you take out interest and taxes, the two main things, depreciation, amortization too, I guess. But you take those out, and then you get to your net margin, and it's gone from 3% down to 2%. 2019 was kind of an off year. 2020 actually a little bigger year, which kind of surprises me since that was the main COVID year. But so a little bit of a decrease. So if you're looking at Walmart, you might want to take a look at that. It's not a huge deal. Nike, they've been kind of all over the place a little bit. As we might suspect, 2020 was a tough year. 2021 came back very nicely. Again, we probably no problems expecting that. There was a lot of, they had a lot of pricing power, meaning that there was a lot of money sloshing around in 2021, and companies could kind of charge what they wanted to. And you see that reflected in their net margin. And Nike's done kind of a nice job of bumping up their net margin a little bit from 10% there to 13% there. How about a company like Microsoft? Operating margin here, 32%. Man, look at that. Ooh, up to 43%. So, they're kicking out, or they're bringing in a lot more revenue with fewer relatively speaking, fewer operating costs, per dollar sold, and their net margin, look at that, a low in 2015. I don't know what happened there. Low again in 2018, but gone from 25% really up to 39%. None of you guys picked Microsoft, but if you were looking at Microsoft, those are huge numbers. Okay, I think a lot of that, if you read their annual report, I'm kind of guessing here, but I find it in the annual report, is that a bigger part of their business has become cloud-based services. Okay, just real quickly, just kind of explain a couple of these other things. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Again, as a percentage. Okay, so probably not that dissimilar from operating margin, but there are a couple other things that are in there. That's what that means. Return on equity is a big number, right? Okay, equity is what we have. If we own shares in a company, we're really interested in what they're earning, for our shares. And, Walmart's clicked along here, gone from 21 down to 17 though, with about Nike 25 up to 46, almost doubled, okay, in the last 10 years or so. And Microsoft, look at that, also almost doubled over the last 10 years. I mean, that's just phenomenal. That's phenomenal management, especially companies their size. It gets tougher and tougher to increase those margins and increase those paybacks. Just huge. Okay, a lot of this then gets into inventory turnover, receivable turnover, those types of things. Really depends, again, on the type of company. A big retail company, you might check. There might be some things there that are going on that have had an impact. Usually you'll spot that maybe in the income statement or cash flow statement, and you'll read it, and it'll kind of be verified by knowing that they're in 2020 when the pandemic hit, sales slowed, and so their inventory turnover really decreased. Okay, we probably find that in some of those, maybe especially like Nike and Walmart. Microsoft, on the other hand, might have done really well because of their cloud services and people going online for doing a lot of things. So those are some good things to look at. Again, I just looked right now at the operating efficiency. We might take a look at some of these other ones here in the next day or two. So we got about a little less than a week left to get your final paper done. So I hope these videos help. Thanks. Have a great day. Enjoy the warm weather for a change.